Welcome to another deep dive. Today, we're looking at something really interesting, maybe even a bit odd, happening in the U.S. stock market. It's Monday, August 4th, 2025. There's been a pretty big rebound today, but the strange part, it's not really about economic optimism. It seems to be more of that classic, kind of counterintuitive, bad news is good news thing.
Exactly. It's like there's this real tug of war going on. You've got these two big opposing forces pushing and pulling the market right now. So on one hand, there's this intense hope that the Federal Reserve is going to cut interest rates. But then, bam, on the other hand, you've got these very real economic threats looming. We're talking new tariffs, a clear slowdown in growth. Understanding this tension, this conflict is really the key to figuring out what's happening today and what it might mean for you.
Okay, so let's dig into that bad news is good news idea first. The trigger seems to have been back on Friday, August 1st. That's when the July jobs report came out. And well, it wasn't great, only 73,000 jobs added. But the real shocker, reading through our sources, was this huge downward revision. 258,000 jobs wiped off from previous months. That makes it the slowest hiring we've seen since, what, 2020? That sounds like genuinely bad news for the economy.
No, it absolutely is. Bad news economically speaking. But connect that dot. That bad news immediately became good news for the market. Why? Because it pretty much cemented this idea, this conviction, that the Fed has to cut interest rates now. You look at something like the CME's FedWatch tool. Probabilities for a September cut, just a quarter-point cut, shot up over 85%. And the market's basically pricing in at least two cuts by the end of the year now.
Right, so the market's essentially happy about economic weakness because it thinks, great, the Fed will step in with cheaper money. But doesn't that feel, I don't know, a bit shaky, like building a rally on a weak foundation?
It is fragile, precisely. It shows you where the market's head is at right now. But like you said, it's immediately challenged by this other massive force, those new U.S. tariffs. They're set to hit on August 7th. And the key thing here is how broad these are. They're reciprocal, hitting dozens of countries, and the rates are significant. 15% for the EU, maybe 35% for Canada, India, 25%, even Switzerland facing nearly 40% on certain goods.
And the potential fallout looks pretty serious. Sources like the Budget Lab at Yale are forecasting, well, a drag on U.S. GDP, higher unemployment, and big price hikes for consumers. Things like shoes up 40%, clothing 38%, maybe $5,800 extra for a car because of a 12% rise. That's significant.
It really is. And this brings us to the core paradox, the tricky part. The market's rallying because it expects rate cuts due to economic weakness, right? But a major driver of that weakness is these tariffs. And here's the kicker. Tariffs are inherently inflationary. They're like a tax on imports, pushing prices up to the Fed. They're caught in a really tough position. You've got slowing growth, but also rising prices. That's the classic recipe for, well, stagflation concerns.
Okay, so despite the rally today, there are signs people are still nervous. Like the VIX, the volatility index, it jumped on Friday, and today, even with stocks up, it's staying kind of high, around 19. For you listening, a VIX around 19 usually means there's still quite a bit of unease, right? Even if prices are going up. It suggests this rally doesn't have everyone convinced.
Exactly. That divergence is crucial. Rising stocks, but stubbornly high volatility. That screams low conviction. It suggests traders might be buying, sure, but they're also buying protection, hedging their bets. And look at the sectors leading today. It's what we call risk-on tech, a consumer discretionary financials. But the driver isn't necessarily, a booming economy. It seems more about monetary policy safety. The thinking is lower rates help these growth-oriented stocks the most. So it feels a bit speculative, doesn't it? Chasing the stocks that benefit most from cheap money, not necessarily the ones reflecting true economic strength.
We even see it in individual stocks, big gainers like IDEXX Labs on earnings or CommScope on M&A buzz. But then you have disappointments too, like Berkshire Hathaway seeing profits dip or On Semiconductor just meeting, not beating hopes. It's a mixed bag under the surface.
Definitely. So looking ahead to the rest of the day, probably choppy. This rally feels, like we said, low conviction. It could easily fade. That fundamental contradiction cheering weakness while facing inflationary tariffs, that hasn't gone away.
It's not a straight path forward then?
No, not at all. It's this constant push and pull between hopes for Fed action and the real-world impact of these trade policies.
So wrapping up, what does this all mean for you? How could this tug of war play out in your own financial life, your planning? Really think about this bad news and good news logic the market's using right now. What happens if those tariffs do start to bite on inflation, making things more expensive while the economy is still weak? Where does that leave the Fed and, ultimately, you? Something to definitely keep an eye on in the coming months.